Welcome to this explainer. Look, if you've been feeling like you're doing absolutely everything right but still somehow falling behind, I want you to stop reading traditional personal finance advice online right now. Seriously, just stop. Every book, every app, every guru teaching you how to build wealth starts from the exact same fundamental assumption that you already have something left over to invest. But today, we're diving into exactly why that traditional financial advice is completely failing you in 2026. More importantly, we're going to uncover how a forgotten, battle-tested system from the Great Depression offers a highly replicable path to building wealth from absolute zero. So, what do you actually do when there is literally nothing left at the end of the month? Let's start with the modern trap. Think about this reality for a second. 57% of Americans cannot cover a $1,000 emergency expense. That means most wealth-building advice out there starts with capital that simply does not exist for the average person. When the spreadsheet has been perfectly optimized, the subscriptions are canceled, the coffee's cut out, and your bank account is still sitting at zero, what's the next move? That's the question nobody really wants to answer. Here's the roadmap for today. 1. The hidden entry fee. 2. The 1929 crash precedent. 3. The 5 historical wealth methods. 4. Applying the blueprint today. And 5. The ultimate historical lesson.
All right, Section 1. The hidden entry fee. A look at our modern reality.
The crucial point you need to take away here is this. You're not failing because you're careless, and it's not because you don't have the drive to be wealthy. You are struggling because the system that teaches wealth has a hidden entry fee built right into it. It totally assumes you have surplus cash after rent, groceries, transportation, and utilities. If you're starting from zero, you just can't use a blueprint meant for someone starting with 50 grand in the bank. Wealth built from nothing requires a completely different starting line. Moving right along to Section 2, the 1929 crash precedent, a true test of survival. 89%. Just let that number sink in for a moment. This brilliantly illustrates the sheer severity of what they were facing back then. By 1932, the stock market had lost 89% of its peak value. 1 in 4 Americans was entirely unemployed. Nearly 9,000 banks completely failed, wiping out the life savings of millions of people literally overnight. Families who spent decades building wealth watched it vanish in an instant. Honestly, it makes the economic pressures we're facing in 2026 look almost comfortable by comparison. But here is the wild part the history books usually skip right over. Between 1929 and 1939, right in the middle of all that absolute despair, a specific category of people didn't just survive. Actually, scratch that. They did way more than survive. They built the foundations of lasting generational wealth. And they didn't do it because they had secret money stashed under a mattress or got lucky. Many started from zero or even below zero. They built this wealth because they understood a very specific pattern that today's financial algorithms just do not teach. Which brings us to Section 3, the 5 historical wealth methods. This is the recovery blueprint. We're going to dissect 5 exact strategies recovered directly from diaries and federal records of the era. Skill arbitrage, distressed asset positioning, the seed before harvest, necessity business positioning, and hard asset anchoring. These prove that a massive crisis can actually be a signal to start rather than a sign to stop. Method 1 is skill arbitrage. This concept completely flips modern advice on its head. See, most folks today treat investing as the starting point. But Depression-era survivors, they treated investing as the finishing point of Phase 1. Phase 1 is producing income from absolute zero. A perfect example is this unemployed Detroit factory worker in the 1930s. He learned basic electrical repair from a neighbor and started charging just 25 cents a call. Within months, that side income was beating his old factory wage, and by 1941, he owned a full-blown contracting business. He didn't start by investing. He created income first. The investment only happened because the new income existed. Method 2 is distressed asset positioning. Just look at this comparison. A share of Coca-Cola in 1929 traded at 19 bucks. By 1932, it had plummeted to $3.23. That is an 83% collapse. Visionaries like Benjamin Graham, the guy who later taught Warren Buffett, and Conrad Hilton were buying up everything they could during this time. Why? Because they understood that price and value are two very different things. Coca-Cola's infrastructure, its product, the demand for it, none of that dropped 83%. The price collapsed due to sheer panic, not fundamental destruction. While the crowd acts on pure fear, those with historical awareness see distressed assets as a massive, once-in-a-lifetime opportunity. Okay, method 3 is the seed before harvest principle. This totally echoes the famous 1942 Victory Gardens. Did you know 20 million individual backyard gardens produced 40% of the nation's fresh vegetables back then? The financial equivalent is just as stunning. Consider a Kansas City postal worker in 1935. After rent and food, he had maybe $1.40 left to his name, but he started putting just $1 per week into distressed bank shares and bonds. By 1955, thanks to compounding, that tiny account was worth $14,000. To put that in perspective, that's the equivalent of about $160,000 today. The absolute crucial takeaway here is that the seed doesn't need to be huge. It just needs to be planted with relentless consistency. Method 4 highlights necessity business positioning. During the Depression, luxury businesses were totally wiped out, but businesses focusing on core survival needs, they survived and they thrived. Did you know the whole concept of the dollar store was actually invented in the 1930s? Grocery stores extending credit, or pharmacies offering reduced-cost health supplies, these places became indispensable community institutions. They built incredible, lasting wealth because they completely abandoned the luxury market to sell what people absolutely, literally needed during a time of extreme scarcity.
And finally, method 5 is hard asset anchoring. In the Dutch hunger winter of 1944, city residents were trading family gold just for potatoes. Why? Because the farmers knew that paper money, once it's disconnected from real value, can completely fail. But a hard asset, like gold, it held its true worth. In America, the Depression-era equivalent was land. Midwestern agricultural land lost up to 70% of its value in the 1930s. But the folks who managed to buy even small, joint parcels held assets that fully recovered and far exceeded their previous values by the 1950s. Hard assets aren't just an inflation edge, guys. They are an anchor against the failure of the system itself.
Section 4. Applying the blueprint. Let's talk about your 2026 strategy. First things first, we have to look at the math. The average American household right now is carrying nearly $10,500 in credit card debt. National credit card debt is at a record $1.17 trillion. You simply cannot build wealth while carrying that kind of modern burden. Think about it. If you're earning a 7% return in an average index fund, but you're paying 21% in interest on your credit cards, you are literally just running backward on a financial treadmill. Debt at a higher rate than your return destroys wealth. Period. Full stop. The Depression survivors understood intuitively that you have to plug the gaping hole in the bucket before you even try to fill it with water. So, to execute this historical blueprint today in 2026, here is your precise order of operations. 1. Eliminate those high-interest liabilities first. Kill the drain before you fill the tank. 2. Create skill arbitrage. We have AI now. Leverage modern AI tools to spin up a service with near-zero overhead and cut traditional business costs by 60 to 80%. 3. Once the liabilities are cleared, plant the seed. Start with just $5 a week using fractional shares of the S&P 500. The asset is modern, but the 1935 principle is identical. 4. Position yourself in modern necessity sectors. Think energy stability, food security, or healthcare. And 5. Anchor a portion of your portfolio with hard assets, like Treasury I-bonds or productive land. Which brings us to Section 5, the ultimate historical lesson. Learning to read the pattern. The ultimate, undeniable proof of this entire system is Benjamin Graham. The man lost almost everything in the 1929 crash, but he didn't give up, and he didn't wait around for the government to fix it. Instead, he wrote the seminal book Security Analysis in 1934, smack in the middle of the absolute worst economic period in American history. He didn't wait for conditions to improve. He studied the market because conditions had collapsed. The people who built wealth in the 1930s didn't have better luck. They had better information. They didn't panic, they recognized a pattern. And that brings us to our final provocative thought for today's explainer. I want you to evaluate your own 2026 reality right now. Ask yourself, which of these 5 methods, skill arbitrage, distressed assets, the seed principle, necessity business, or hard asset anchoring, applies most directly to where you are starting from today? The blueprint has been written, the pattern is running all over again. The only real question left is, how are you going to use it to start building your wealth from zero today? Thanks so much for joining me, and keep learning.